Thanks and good morning, everybody. It's a real pleasure to be here, particularly because I'm sitting next to two erstwhile colleagues as I sit up there. The world is full of regulators and ex-regulators, you'll be very sad to hear. What I'm going to talk about is this pace of change that we're facing. I've worked in the financial services industry for the best part of 30 years. We've always talked about change through that time. We've never had this mythical time of a status quo that is stable. But I have never known a period of greater change than the one we're facing now. And so I want to put my remarks into three buckets. We've got political change, we've got regulatory change, and we've got the thing we keep talking about, the technological change that's coming at every part of the financial services industry. Now, a lot of those changes have the potential to bring really great benefits. And it's so important to hang on to that. For me, as a regulator, we have a horrible tendency to do nothing but talk about risks. But it's so important that the regulatory community, and indeed more broadly, we focus on the potential for benefit that can come through these changes. But perhaps before I get to some of those bits, the first thing I want to talk about is Brexit. Now, the FCA has been very clear, and I think the regulatory community in the UK has been very clear that we put great importance on open markets and regulatory cooperation. They have underpinned a great deal of economic growth around the world, and we think that they should continue for the future. But we recognise that they can't continue unchanged. What we need is regulatory cooperation based on the comparability of rules. That doesn't mean mirrored rules, it means comparable rules. On strong supervisory cooperation, on effective exchange of information, and on mechanisms to deal with differences, which we all recognise can arise. Now, there are a great many firm relocation conversations going on and structural changes to multi-hub models. That means that we need to ensure we do have the necessary measures in place for effective supervision. And specifically, we are working to secure those arrangements with our colleagues across Europe for effective exchanges of information with other regulators and supervisors. Because frankly, we're moving into a world where cooperation is going to be even more important, not less important. Overall, our aim is to ensure stability from the point of view of consumers and investors, and that means tackling a number of issues to ensure that we get an orderly transition and avoid cliff edges. So we're working very closely with our regulatory colleagues at the Bank of England, the PRA, and indeed others to avoid this. And you'll have seen that we took some steps back end of last year to ensure that those branches that operate in the UK can continue to do so in the way they do now from next year onwards. We're also working to ensure that we have a robust regulatory system on day one, and that's a hugely important point. But I want to call out one particular piece because it's a subject very close to my supervisory heart, which is an area we're watching very closely, is around the continued ability for UK asset managers to manage global and EU funds on a delegated model. Now, this isn't an EU model, it's not a UK model, it is a global model that has delivered, again, real global benefits in the asset management industry and to the economy, again, as a whole. We think that over £1 trillion worth of EU domiciled funds are in fact managed in the UK on a delegated basis at the moment. We think there is absolutely no regulatory or supervisory reason why this has to change. The current rules around delegation and outsourcing work quite effectively. They're based on strong and effective cooperation and strong supervision of any of those delegated entities. Any change to that would unnecessarily complicate an effective and working system. So we do think that it would be extremely unfortunate were that to change. But moving on perhaps to a more positive set of issues, and that's not often the phrase I use because I'm going to talk about regulatory change. Now, Alex talked a lot about the prudential response to the crisis, but that wasn't the only response to the crisis. There's been a substantial, what I would broadly call, conduct response to the crisis too. In regulatory terms, the most obvious manifestation of this was MiFID II that came into force earlier this year. Now, we spent an awful lot of the last couple of years talking about MiFID II, and through last year, we largely talked about it in terms of compliance, get ourselves over the line, get ourselves to the point where the UK is broadly compliant with MiFID II. But we shouldn't forget that the point of MiFID II is to deliver quite substantial market structural changes. And those changes should be overwhelmingly beneficial. There's strong changes to the transparency of our markets that we're looking to see. Strong changes in our ability to surveil markets and monitor markets, so we have more transparent, cleaner markets all across Europe. Now that has only been in force a little while. It's way too soon to establish whether or not we're achieving the goals we needed to achieve with that, and that everybody in the regulatory community across Europe has been committed to achieving. But we need to move the debate on MiFID II away from that narrow compliance piece and back to a recognition of what we're trying to achieve there and a testing of whether we've achieved it. So you can expect to see more work done by us as we move forward around that. One particular area I might call out is that there's been continuing concern around the unintended consequences of some of the rule changes around how to charge for research. And how that might play through. Now that might sound like a narrow technical piece, but there's been real concern that in the unbundling of costs around research, there could be a real chilling effect on the provision of research on smaller and medium-sized companies across Europe. Those are the companies that drive prosperity across Europe. Now that is definitely not the intention of the unbundling provisions. But we need to keep a very close eye on that as that works through the system over the next couple of years to see what effect those rules have actually achieved. The other piece I'd call out, again, like Alex, is the change around open banking and PSD2, where regulatory change is pushing and deliberately pushing at the facilitation of innovation, increased competition, greater choice for consumers, and indeed lower prices for consumers. That's what it's for. It's a drive for change, again, regulatory push for real market structural change. It's designed to enhance the ability of businesses to develop new services, to help customers manage their finances and compare financial products. It's designed to enhance consumer protection by increasing responsibility around unauthorized transactions. And it's designed to enhance security requirements by bringing those providers in scope of regulation, in the scope of the FCA's oversight. And we have set standards around that, which should over time increase security. But we do recognize there are risks here too. Those are risks that the banks are calling out. They wouldn't they? A lot of this is attacking some of their clear interests in the status quo. But the risks are real here. There are undoubtedly concerns around the business models that might come through as a result of this, business models based on the aggregation of client data. And we therefore need regulatory checks and balances, and we will be putting those in place. But of course, all of this is underpinned by technology change. It's being facilitated and prompted by technology change and the data revolution across all parts of this industry. Technology is bringing huge benefits. It's enabling innovation, supporting disruptive business strategies, though we recognize that some firms may struggle to compete in an increasingly technological-driven industry. The challenge for regulators is how to engage positively in that world. The instinct of regulators can often be to say no, to focus on the risk, not on the opportunity. It's so important that the regulatory community looks up and out and beyond some of those risks. So we're trying to bring participants together. We've talked a lot in the past, I think, about the FCA sandbox. I'm not quite sure when sandpits became sandboxes, but somewhere in my life they did. We have a regulatory sandbox that allows innovative players to come and develop solutions, not against lower standards, absolutely not against lower standards, but a safe place to play, a safe place to explore whether there is a way for innovation and for fintech to deliver stronger customer outcomes. But there, as we look at automation, algo trading, whatever it might be, reliance on third-party technology providers, that's a really interesting one for us as regulators. the growth of blockchain. All of these bring risk, and we can't ignore that. So just quickly, cryptocurrencies, the risk du jour, if you like, that a lot of regulators are increasingly concerned about. Something we have focused on within the UK. We've published guidance as the FCA on warnings around cryptocurrencies attached to CFDs. That's a really interesting, potentially very toxic mix. We've put out warnings around this. We do consider these products high risk and should be treated accordingly. We've put out guidance on algo trading and the way firms have to think about the management and control of risks on algos, done that in conjunction with the PRA. So there's a great deal of innovation here, recognise it's going to help, recognise real benefits, but we are putting out guidance around the risks. And there are obvious harm that can flow from data, whether it's the loss of data, the misuse of data, the theft of data in a cyber context. Now, we could talk for hours about the cyber risk. Suffice to say that we work very closely with our colleagues at the bank and the PRA on the mitigation of cyber risk. The FCA has a two-pronged approach here. Firstly, we have a supervisory approach to drive institutions' ability to prevent a cyber attack in the first place, or successful cyber attack in the first place, but also a response function to deal with an immediate attack. We work with all of the agencies across the country to make sure we are well positioned to respond to that. One thing we are doing is developing standards that we expect of institutions to respond to these things. And one of the live questions here is, what is the role of regulator in setting standards in this area? Do we set technical standards, or do we set outcomes to be achieved? My own view there is we should set outcomes to be achieved. Rules are not very well designed to set technical standards. By the time we've consulted on them and made rules, you can guarantee the world has moved. But it's a very live debate across the regulatory community as how we should approach that. But I come back to that outsourcing piece. One of the regulatory issues here is, are we focused on the right institutions? Increasingly, firms use the big four global technology providers to support the functionality across financial services. Amazon, Microsoft, IBM, Google. They're not regulated entities. They're not within the remit. So that's our challenge, and perhaps the challenge for all of us in the future. Are we focused on the right firms? I will stop there.